Alrighty, let's go ahead and get started. I really do appreciate everyone being on with us today. If you do have any questions, type those into the chat box, or if you would like a copy of the slides, they are attached as a handout as well. So today we'll be covering some aspects of small business plans, as it's important information for people to gather, especially with the extended filing deadline coming up next month. So for those of you that are small business owners, self-employed, sole props, sub-S's, if you would like to make a contribution or establish one of these kind of plans we're going to be covering today, keep in mind that you do still have time to get some great tax deductions or create retirement plans for last year still here in 2025. A little bit about me. My name is Alex Perny. I've been with Advanta since 2012. I have a real passion for the small business community and the plans associated with them. So again, if you do have any questions, we're not covering something, you want a little bit more information on something specific, don't hesitate to chime into the chat or give me a ring sometime. We are always happy to help you. Now, especially today, it's important that you understand kind of where services start and stop, as we will be covering some stuff that definitely will have some taxable implications if you take action on it. Advanta IRA and our employees do not provide investment or investment advice, nor do we endorse or promote any products. All information and materials are for informational purposes only, and all parties are encouraged to consult with their attorneys, accountants, and financial advisors before entering into any type of investment. A little bit about Advanta IRA. We've been around for over 20 years, something we're very proud of. We have a lot of great staff on board, including attorneys, CFPs, different designations within the banking community. So we definitely have a great breadth of knowledge to help and assist clients with making some of these kind of decisions. We have over $3.5 billion worth of self-directed assets that are spread across a multitude of different types of investments. So if you are looking to do this for a specific type of investment or something that's a little bit outside the norm in the alternative asset space, we are the people to help you out with that. All right, thanks. I think someone just said that you should be able to see everything now. We haven't gotten into any of the meat of it. We'll just go back real quick 2 slides, so that way it does show up for everyone with our disclaimer and my contact information. But thank you for the person that let me know that you could not see the visuals. So I appreciate that. Again, if there are any other issues on the other side, let me know, and we will make sure those get addressed. And from there, again, all of our clients have dedicated personal account management here at Advanta. So any client, no matter if you are a $1,000 client or a $1 million client, you always have that great specialized personal service that you need to be able to do these kind of investments quickly and efficiently. So that's something that we're very proud of. If you do want to learn anything else, again, by virtue of you being here, you are participating in one of our events. We also have a podcast that I host, the Alternative Investing Advantage podcast, where we have a multitude of awesome guests. We are closing in on our 200th episode, something that we're very proud of. It's been a fun journey to bring a lot of great guests and information to people over the years. And we also maintain an up-to-date blog on different industry happenings and things that are important for you to know, especially if you are in the self-directed space. I'm just trying to expand the window with the questions real quick. All right. So now, especially for those of you that are self-employed, maybe a lot of you probably are in the real estate realm, there's a lot of opportunities for you as real estate professionals for utilizing these plans to capitalize on your own expertise, and especially being able to invest these plans in real estate, and also to help garner more capital and exposure to yourself for your deals, coming from the way of understanding that self-directed IRAs can be used as a funding source for your deals as well. And again, for your clients, it's incredibly powerful. There's trillions of dollars invested in retirement plan assets. So utilizing these things on both sides of the coin, especially if you are a real estate professional, can be incredibly, incredibly powerful. And again, self-directed IRAs, it does allow for, and self-directed retirement plans in general do allow for alternative investments in a multitude of different asset classes that are not just stocks, bonds, and mutual funds. Now, a few key takeaway points here today. The extended deadlines, one I think most of you probably understand that mid-October, the 15th is going to be when your extended filing deadline is this year for businesses. Now, keeping in mind that if you have already filed a return, you cannot then in turn take advantage of utilizing these plans on the extended deadline. You have to have not filed your taxes already in order to be able to set up a SEP IRA or a solo 401k to be able to make last year's contribution. So unfortunately, if you have already filed your business return, there is no capacity for you to still take advantage of that. But assuming that you're still on an extended filing schedule, then you definitely still have time. We can do these things up until the day of the filing deadline. I did it for a client last year. It is a little bit of a scramble, but we're here to help. So, no matter where you are in that process, if you have not filed your taxes yet for last year on the extended filing business deadline, you still have that ability. The different employer plans and their drawbacks, right? So it's not just the solo 401k. I know it gets a lot of press. It's not just a SEP IRA. It's not just a simple. Each of these, there's a reason that we have kind of three different main employer-based plans, is that they all offer different benefits. And depending on the kind of revenues you make, depending on the type of tax deductions you want to take, and depending on your penchant for plan administration, what responsibilities you want to have and what you need from the plan, again, choosing one of those is very, can be catered very, very specifically to you. And then the contribution limits for the various plans. Again, understanding when you can do these, how they actually operate and function, and what your limits for actually putting money into there and how those limits differ depending on the amount of revenues that you're making is very important. It's something I want to make sure that everyone takes away from this presentation today. So again, what are self-directed retirement plans? Well, IRAs, 401k, SEP IRAs, HSAs, ESAs, all these different kinds of plans can be self-directed. And there's, kind of in the general looking at these things, a self-directed IRA is inherently just a marketing term, right? But the way that it's utilized in this context is that you can use these plans to invest in anything that's not on a publicly traded market is what we handle. So for those of you that are interested in things like private stock, LLCs, real estate, debt, all these different kind of interesting alternatives, you can utilize these plans for. It doesn't have to be a after-tax plan like a Roth. It can be pre-tax, it can be an HSA. All of these different kind of plans work to invest in these different types of assets. One of the things I hear, more often than I kind of understand why, is that you can only do something through a Roth account. It's not the case. Any of these kind of investments that we're kind of allude to today, or that you might have in mind, can be done through any of these different types of plans. So definitely something good and important to remember. Now again, why do people choose to do this? Again, it's a new source of capital, right? It's something that you can lean on for a new bucket of capital that you can create great tax treatment for. So whether you want to defer taxation and create tax deductions for yourself personally and your business, whether you want to go ahead and take on that tax burden now, but it's something that you can utilize as a new bucket of capital separate from your present savings or your present operational capital. A lot of people are fatigued with the stock market, and it kind of goes both ways, right? We get really tired of it when it's bad, and when it goes too well for too long, some people, myself included, start to get leery of how long things can continue down that pathway. So fatigue works both ways. And especially when things are up and doing well, it's always a great time to look at diversification with regard to how you're allocating your assets and what you're actually doing, because it's a lot easier to sell when you're high than to say, hey, I'm going to have to take a loss now just to do something different. So again, fatigue being a big reason why people choose to do this, and then also the tax benefits. And it's especially apparent here when we're talking about small business plans, because the contribution limits are so much higher. Dollar for dollar, looking at someone under the age of 50, it's a 10 times higher contribution limit maximum to a solo 401k than it is to a regular IRA. And with a solo 401k or a SEP IRA, you can still make your annual IRA contributions as well. So you can use these types of plans in conjunction with IRAs, and some including like the SEP IRA can be used directly adjacent to an IRA, right? A SEP is a component of an IRA, and you can make those contributions directly to those plans as well as an additional kicker. So that's something that we're going to cover here in a moment. Is just kind of how beneficial they are from a tax perspective on how much money you can get into these plans and where those deductions, or again, the increased amount of tax-free savings can be had. And again, to the assets that you can utilize these for, because it's all well and good to understand that, hey, I can make these contributions, but if you just stick cash for kind of sticking under the mattress, you're fighting inflation, right? That those dollars that you contribute to a retirement plan, if they remain uninvested, will be worth less tomorrow than they are today. Again, it's kind of a sad fact of how the our economic situation works. But again, over the entirety of human history, right, inflation just continues to go up. It ebbs and flows, but again, as a face value, right, we need to be investing these funds and making informed decisions and utilizing different strategies that will help us to grow that and fight the inflationary effects of just dollars being worth less tomorrow than they are today. And especially when it comes to investing in tangible assets, right, things that can cash flow. That's where a big benefit of these types of retirement plans that you self-direct really shines. And the nice thing about it too, further to that point, is that you're not just limited to a constraint going to be being placed on you by us as the custodian. If you want to implement a strategy that maybe is fix and flips, long-term rentals, rehab projects, we have people that do tax deed. I just connected someone with a tax deed professional this morning. Mobile homes, different real estate syndications, and private stock. The real estate market is something that, especially with days on the amount of inventory and days on market starting to really kind of creep up, it's going to really create a massive opportunity for us as real estate investors to go out and actually start to find some deals, which have been so incredibly elusive from a price point perspective over at least the past 4 years. And everything basically after COVID has been a continual gasoline fire with regard to pricing. So now that we might be seeing some cooling in the pricing aspect of real estate, being able to use these plans to invest in that and have tangible real assets within these plans is very, very attractive. And it's not just on the equity side of the purchase as well. You can do things like mortgage loans, tax deeds and certificates, unsecured lending, option contracts. There's a multitude of different alternatives. And then further to that, if people have invested in it, we've pretty much seen it. So long as that it's legal and can be properly tracked, we've had experience in it. So I just like to make sure I include these slides, especially in some of the potentially shorter presentations that we do, so you get a well-rounded idea of not only the benefits of these plans from a contribution and tax perspective, but also a perspective of just how diversified you can create asset allocations with these types of retirement plans. So understanding the key components of an employer plan is important. Just because someone wants a solo 401k because saying, hey, you can contribute 70 grand to this plan as a Roth contribution per year is attractive. I don't care who you are, it's a pretty attractive proposition. But just because you want something doesn't always, just like in life, doesn't mean that it actually can matriculate to a point that you can actually have it. Now, small businesses don't necessarily have to be, one size does not fit all. There's a lot of people out there that just operate a sole proprietorship, right? Just flows through to your personal income tax statement. You could be a single member LLC treated as a disregarded entity, or taxed as an LLC, or taxed as a C Corp, or elect a sub-S election as well. All of these kind of things will work for the establishment of a business retirement plan. So your SEP IRAs, your SIMPLE IRAs, your solo 401ks, but you have to have some type of business activity. If you just go work a 9 to 5 and that is your only income, or let's say you just have passive dividend income from something, and you don't treat it as business income in some form or fashion, whether that's sole prop income, sub-S, LLC, something that is attached to some type of business activity, unfortunately, you cannot establish one of these kind of plans. But again, the bar is so incredibly low that it's pretty easy to be able to structure things and in a manner, if you're not already doing so, that would allow for that. And I run into that kind of situation with plenty of people. I was talking to someone last week that definitely has the potential to treat some of this as business income. They own several rental properties, they manage them themselves, but they just had them in their personal name. Now, again, can't give tax or legal advice. I absolutely connected that individual with someone, a tax professional that can look and see, hey, is this going to be an advantageous thing to restructure some things, maybe put these properties under some type of corporate structure, or treat the income as sole proprietor income. There's a lot of different ways to do that. But again, just because you don't think you have a business, especially people that connect with us more often than not have the ability to potentially restructure some things to treat things that they're doing as a business to allow them to utilize one of these types of plans. So again, you always have to have a sponsoring business entity. It can't just be you as an individual by virtue of the fact that you want one of these plans, right? You have to have some type of, actual business activity. You also have to have participants and employees, right? Now, for the self-employed individual, you are the employee, you are the boss, you wear a multitude of different hats, especially I know it's kind of preaching to the choir to say, hey, a small business owner, an entrepreneur wears a lot of different hats. But from the purpose of the IRS's standpoint in the Department of Labor for these types of plans, it's important to understand how you interact with these plans, right? Because when you are utilizing one of these plans, it's different than just a regular IRA, right? The business is attached to the plan and you are participating in that business and getting to utilize this retirement plan benefit. Again, these are the same kind of plans that large conglomerated businesses use, right? But they are just distilled down and that benefit is offered to you as the self-employed or small business owner. Right? So understanding some of the terminology is also important. So you are the participant, you are the employee of the business. So when you hear me talk about employee versus employer contributions, right, it can be one and the same, right? It's just a matter of where those contributions are being calculated from and also how they are being deposited into the plan and where some of those potential deductions are being taken and where some of them, might be better off when looking at how you're actually structuring something corporately to be able to better be taking advantage of these tax situations to be more tax efficient, right? And then contributions, right? So the third prong of this is the contributions, how they're actually made, how you calculate them, where they actually come from, right? Because it's not just going to be saying, hey, look, I have this, let's say you have the sponsoring business, you understand that you are the participant and the employee of that business. But if that business has, let's say, $10 in net revenue on a given year, but you have $10 million in the bank, well, good for you, right? You have certainly done well and have accumulated a lot of capital, but the fact that the business revenues aren't commensurate with being able to make the contributions, again, that is another important aspect to understand, is that you have to have the revenues match up with the calculations for making these contributions as well. So sponsoring business, participating in employees, and contributions are the three big things to take away in understanding these small business plans. The self-directed plans that we offer, again, traditional Roth, inherited, HSAs, ESAs, and the small business plans that we offer are solo 401ks. We do a do your own 401k, which basically is, people like to call it a checkbook control 401k. It is the most bare bones and straightforward plan that we offer. We offer standard record keeping for a solo 401k and an enhanced plan with record keeping and reporting as well. SEP IRAs can be Roth or simple, and simple IRAs can be Roth or traditional as well. So question, so if you have an LLC and start a SEP Roth IRA for the business with 4 partners and contribute to that SEP, the Roth SEP, can you also contribute the normal Roth IRA contributions? Yes, so a SEP IRA, functionally it's important to understand how a SEP IRA works, right? So a SEP IRA is a component of an IRA, right? It's how they kind of treat it from a very technical perspective, right? So a SEP IRA that we all know and love used to just be a SEP component of a traditional IRA. Now that we have the Roth SEP by virtue of the Secure Act 2.0, now you can do it as after tax, right? So you can have a Roth SEP. So basically, you can make your contribution directly into that plan, the $6,000 or $7,000, or the $7,000 or $8,000, depending on your age, into that plan directly, as well as the salary deferral, which we will get into, I believe it's on the next slide as well. So great question. It's certainly definitely something that is a little bit on the more esoteric side of things to understand on how SEP IRAs kind of actually work, but they certainly is kind of a new and interesting way that they can actually play out. So good question. All right, so retirement plan contributions. If we are looking to last year, I will go one slide ahead because it's a little bit more relevant to what we're talking about now. And then we'll go back to the current year contributions because there are some cool things that actually came into effect this year as well. So for 2024, right, the traditional and Roth IRA contributions are off the table, right? So you can still make SEP contributions, the deferral. So SEP contributions are based on compensation, right? So you can contribute up to 25% of comp, up to 69 grand for last year. So you take your total compensation number and then you multiply by 0.25, that gives you your number. And we'll look exactly how that plays out in the next slide. I'll actually show you the math and the comparative analysis between everything. Simple IRAs, again, we've missed the mark on you being able to still establish one and contribute for last year. They have a different contribution schedule and timing schedule. It's actually the plan had to have been established by a certain date of last year to make the contributions for last year up until your extended filing deadline, which would be, again, I think it's September 15th is that date for SEP IRAs, simple IRAs, I should say. But simple IRAs, you can contribute $16,000 of your comp plus an additional kicker of $3,500 if you're over 50. And then you can also contribute 3% employer match or 2% of employee compensation as the additional component to a simple IRA. Not as many people use them. Again, I will be the first one to say that simple IRAs have a very bad name because they are anything but simple to utilize and understand. And every single legislative update continually makes them a little bit more complex. Simple IRAs, again, they have their place. They're good if you maybe kind of operate a small, more seasonal employee business, or if maybe you don't want the overhead of having a 401k, simple IRAs definitely still have their place. 401ks, again, near and dear to my heart. I really like these plans. I think, dollar for dollar, they will offer you a significantly higher contribution limit, especially if you are a sole proprietor, owner-operated business. They really, really shine. So solo 401ks, you can contribute $23,000 for last year of your compensation deferral, which is called your elective deferral, or the employee contribution, right? Remember what I was saying, the components of the retirement plans. So $23,000 would be the amount that you can just kick in out of your own paycheck. So if you ever had a job before, 9 to 5, and you tell your employer, say, hey, contribute 4% of my compensation, that's what that works out to be, right? So you can contribute up to $23,000 of your comp, right? Your taxable self-employed income, right? What's subject to FICA and FUTA, you can just contribute $23,500. Or if you're over the age of 50, you get an additional $7,500 kicker, right? That's a pretty substantial kicker as opposed to the $1,000 you get on the IRA, right? So your total just elective deferral being $30,500 is really cool with regard to that. And you can also contribute up to 25% of your net operating income, or depending on how you're actually accounting for your revenues of the business. Again, if it's all through a pass-through, then you can take your total comp and then you can kick in an additional 25% of total comp, not to exceed a plan contribution limit of $69,000 or $76,500 to that plan. And I know that's kind of, at least on just hearing me say that or looking at this sheet, it doesn't make a whole lot of sense, but when we do the next slide in a few slides, you'll actually kind of see how that actually plays out in real time. Then I also leave the HSA and the ESA coverages up there just so people know. Here's the change for 2025, right? So you can make a 2025 contribution. You don't have to wait till after the year's up. But keep in mind that especially, the reason that you get the extended filing deadline allowance for this is that you don't know how much money you made in your business till you close out all of your accounts after the end of the year, right? You don't know how much money you made, or you're paying yourself for a lot of things till after the first of the year at bare minimum, right? But again, if you do know, great, you can still make this current year contribution to these plans. But we did have some nice upgrades, coming into this year, especially with some provisions of the Secure Act that kicked in for individuals that are 60 to 63, specifically looking at solo 401ks, right? So on the previous slide, I mentioned that you have a total net contribution allowance of up to 70 grand. So we get an additional $1,000 kicker in total if you're over the age of 50. But if you're between the ages of 60 to 63, you get an even higher additional catch-up contribution allowance, which brings your total plan contribution up to $81,250 per year into a solo 401k. Pretty awesome, right? So now you have Whereas before, especially for those individuals 60 to 63, it was apples to apples for the total contribution limit between SEP and solo 401ks. Now you have a delta of over $10,000 between the plans, right? So it's very interesting for how that's going to play out. And again, this is 2025 contribution limits. Namely, kind of the point I'm trying to make is that with these plans, if you still haven't filed your taxes, you have an extended filing deadline. The 2024 contributions are a little bit more of a parent benefit to most of you, but understanding what your retirement plan contributions are this year, especially if you want them to make some, are important as well. So here's kind of what we're going to look at for the contribution limits. Okay, so someone asked a question. So on this slide, someone's like, can you do both of the first two top lines on this chart? I mean, yeah, a traditional and or Roth and a SEP IRA, absolutely. Yeah, but your contribution limits, right? Your traditional, you can have a traditional and a Roth IRA, but you cannot contribute over $7,000 per year to that plan, right? You can't do both. Like say, hey, I have a traditional and a Roth, I'm going to put in $14,000, right? You can't do that. But you can have a traditional and or a Roth and a SEP IRA. So you can definitely do all of those. It's definitely not a problem at all for that. Alrighty. So contribution comparisons. So how does this actually play out? And again, the numbers are basically $1,000 off. Just knock $1,000 off of this. This is just looking at 2025 because I wanted to include in the additional provisions as well. But it paints a very accurate picture. So assuming $100,000 of compensation, right, for this, right? What does a simple IRA look like? Well, it's $21,750 would be your total plan contribution for this year. It'd be $20,750 if you're looking at last year, but with the difference, right? It doesn't really matter, but it's important to understand. So $21,750 for this year, which is made up of $16,500 of salary deferral and a $5,250 employer match. Now, SEP IRAs, super easy to understand, right? And it's been the same for quite a while, right? So it's 25% of that $100,000, right? So SEP IRA, 25% of $100,000, $25,000. Now you can effectively look at it and say, hey, look, I can also do that in conjunction with my IRA contribution, but IRA contributions have to be made by the timely filing deadline, even if you don't file on a timely schedule. So you can't say, hey, look, I'm just going to go ahead and contribute $32,000 or $33,000 to this plan, being a conjoined measure of your SEP deferral and the traditional or Roth IRA deferral or contributions. You can still do those, but they are going to be on a disjointed schedule, right? So if you're going to do that, just keep in mind that you have to make those traditional or Roth contributions by April, and your SEP IRA deferrals can be made up into October, right? So just something to consider with that. But looking at this, right, look at how much more money you can get into a solo 401k, right? It is awesome. And solo 401ks have the additional benefit of having after-tax catch-up contributions as well. So even if you're in that example where I said, hey, let's say you had $10 million in the bank, you can always max out your contributions to these plans by utilizing the after-tax catch-up allowance that our plan documents and then by extension the IRS does allow, which is super cool. We do a whole presentation on the mega backdoor Roth 401k. Another real cool reason why I love those plans. But a solo 401k, assuming $100,000 of compensation, total contribution limit for 2025 would be $48,500, or for last year, $47,500. So you have $23,500 of salary deferral plus a $25,000 employer match. So 25% of the $100,000 being $25,000, in addition to the $23,500, or for last year, $23,000 contribution allowance. Now, the catch-up contributions, I do see that I have 2020 written on. It should be 2025, but all the numbers are correct. Simple IRA is $3,000 for the salary deferral catch-up, so you can add an additional if you're over 50, add an additional $3,000 to the simple total. SEP IRAs don't get any additional allowance. In a contextual sense, you could say, hey, the $1,000 IRA catch-up does apply there, but for all intents and purposes, SEP IRAs do not have a separate catch-up allowance. Now, solo 401ks, again, you have the $7,500 for this year, $7,000 for last year, which again is why I say the delta between those two numbers for last year and this year is just $1,000, right? But the cool thing with this year, if you are between the ages of 60 and 63, your catch-up contribution allowance is $11,250, right? That is awesome. So part of the provisions of the Secure Act 2.0 was that starting in this year, if you were ages 60 to 63, you can do your catch-up contribution is now bumped up to $11,250 per participant, right? So that's really, really cool. When looking at just, again, a apples to apples comparison of all these plans, the solo 401k, definitely comes out on top from a total plan contribution allowance. And for dollar for only making $100,000, you can see just how much more money you can plug into a solo 401k than a SEP or a simple. Again, one of the reasons why I really, really like those plans. Yeah, I did see the typo there. Okay, so again, and again, just to reiterate, and as someone asked, I do understand that the on the middle slides it does indicate 2020. All of the numbers are correct. I just missed that when I was updating my slide. So just keep in mind, numbers are all correct. What I was saying, just the slide did indicate 2020. Now again, want to make sure that we're kind of really clear on, what are some of the benefits? Because maybe sometimes these plan benefits don't really resonate with you as the business owner. And maybe something like a traditional IRA works, right? Because anyone with earned income is eligible to contribute, right? Now your deductibility may be limited based on annual income limits, and if you are involved in an employer-based plan. Again, traditional IRAs, super simple. You get a tax deduction, tax deferred growth. You can roll over old 401ks. Again, they're very great. Now, Roth IRAs, again, are awesome, but sometimes you are ineligible to contribute to a Roth IRA directly because of your income limits, or maybe participation in another employer plan, but you can always do a Roth conversion. Now, the cool thing with especially your solo 401ks is there's no income limitation for making after-tax contributions to a 401k, because 401ks can either be pre-tax or after-tax. So you can make them either all traditional pre-tax and get all of those deductions that are going to flow through to you, or you can make them all after-tax, or you can blend them and just do it omnibus and then do your accounting for it as net earnings attributable to the pre-tax and post-tax basis of the plan. Now, I know that sounds like a lot of word soup, and it is, but it's kind of a good way for me to indicate if you want to do that where you're blending pre-tax and post-tax dollars within the same plan within a 401k, get a good accountant and bookkeeper, or maybe that is your business and you feel comfortable doing it. The 401ks, as I mentioned earlier, are going to be a more complicated plan to administer, but that's kind of by virtue of just the fact that they have so many more options for administering them, and there's so many more things they can do. SEP IRAs, very straightforward. It's a simplified employer pension, right? It's what it stands for. It's very straightforward, very simple. 401ks do have more overhead. They have more things to look at, more options, but you can put more money into them. So again, I think the cost benefit on that is definitely apparent. And again, you can always move between Roth IRAs and traditional IRAs to Roth IRAs. You can do a conversion, definitely not a problem. You can also convert these employer plans. So you can convert a SEP or a simple IRA. You can convert a Roth or a traditional 401k to a Roth, right? You're not just kind of stuck with one bucket. If 1 year it makes more sense for you to try to get as many deductions as possible, and maybe you have a lot of offsetting expenses or you have a lot less revenue that's going to be coming in next year, you can do conversions in these plans. You're not locked into one tax qualification versus another, and you can do them in smaller tranches, right? It's not an all or nothing thing. You can do small tranches of these things, convert at certain rates. You can convert assets in kind as well. So it doesn't always just have to be a cash conversion. There's a lot of flexibility and the ability to really hone in on what's going to be the most tax efficient and best situation for you personally. Again, making sure you get some competent tax advice is going to be paramount, especially when you're talking about doing conversions. But again, they are very allowable and very good things to be looking at. So SEP and simple IRAs, who are they for, right? Sole proprietors, independent contractors, self-employed partners, corporations, S corps, they can be used for all of them. They can be used for tax deferred growth or tax free growth, because we do have the Roth contribution now. They have larger contribution limits and lower costs than traditionally managed 401k plans. Now, solo 401ks do offer the largest potential contributions, but once you start scaling businesses, so if you have rank and file employees, right, you have employees that work over 1,000 hours a year or over 500 hours per year on 3 consecutive years, 401ks can get pretty expensive to administer when you have just a few employees, right? So for those small business owners, the 401k is really great for the sole operator or owner operated business. But once you start having rank and file employees, they can start to get a little bit more cumbersome to administer very quickly, as opposed to the kind of more of a gradual slope of the SEP IRA and the SIMPLE IRA, right? So depending on how you operate your business, what your employees look like, if you don't have them, can really determine which one might be the most attractive. So again, the 401k is great. People kind of look at the big dollar sign, but they don't look at the other thing sitting in the corner of saying, hey, like, this is really great, unless you have employees, which they can still be awesome plans, but they start to get a lot more expensive to administer once you scale operations with business plans. Now, employer-based plans, right? If you do have employees, you don't actually have to offer a plan to every single person, right? Which I know on face value sounds very, Ebenezer Scrooge, right? It's not just writing that down, hearing someone say that is a little bit jarring, if you will. But it's important to understand, right? If you're going to be contributing money into these plans, right? If someone works for you for 3 weeks, do they necessarily want, or should you be offering an employee benefit to them, right? So understanding who can and can't be excluded, especially from the perspective of choosing plans, because they get more expensive when you have employees, but if you can exclude some, just good information to know, right? That's why I include this. So SEP and SIMPLE IRAs, you can exclude from offering the plan to individuals under 21, non-resident aliens, and union employees covered by collective bargaining. Now, what type of employees must be included? Again, solo 401ks, SEP IRAs, simples, if they work for the solo 401k, it is based on the common law or rank and file designation by the Department of Labor, which is over 1,000 hours a year, or with the updates to the Secure Act, they also redefined employees, right, for 500 hours over 3 consecutive years. You can exclude people from a SEP, those who have worked at least 3, or you have to include, for SEP IRAs, those who have worked at least 3 of the last 5 years. And then for SIMPLE IRAs, you have to include those that have received $5,000 in compensation during either of the last 2 years, right? So you have some considerations when you have employees, right? Now, at the very beginning, I said you as the owner operator are an employee, right? This doesn't apply to you. It only applies if you go and hire someone externally. Now, if they are all independent contractors, that's fine. But again, if you are required to do, FICA feud withholding, if you are required, by either your state or the federal government to offer benefits to those individuals, that's also another good kind of distinction on saying, hey, I probably need to look at which plan I'm choosing, because we do have, actual employees of the business. What are some of the advantages of the SEP and the SIMPLE? They're less expensive to administer, and inherently a little bit simpler than a 401k. You don't have as much money that goes in, but they are going to be cheaper from an administrative standpoint, and they're just going to be a little bit simpler, right? You don't have to administer the whole plan here, right? If you have employees and you have a SEP, they could have their SEP at any big wirehouse, your Fidelity's, your Schwab's, your Raymond James, right? And you could self-direct your own very easily. It's very nice from that perspective. SIMPLE IRAs work exactly the same. Contributions are made to IRAs, so again, it's a lot easier from a bucket standpoint. Just say, hey, I'm making a SEP contribution to you here, I'm making mine here, and just letting the bookkeeper, take it from there. The employee contributions to those, again, with only 2 years of service for a SIMPLE or 3 years for the SEP, is the top end of whom you can exclude or you have to include with those type of contributions. Let's see, got a question. What rollovers can be made to a solo 401k? Okay, so rollover rules. Now, we talked a lot about contributions because that's the big bucket, especially with regard to your deadlines that you have for solo 401ks, right? But what kind of monies can be rolled into them? right? So you can roll in an old employer 401k, an old Roth employer 401k. You can roll in 403bs, pre-tax for governmental 457s. You can roll in TSP funds, traditional IRA funds. The reason I list so many is that there is one odd caveat that you have to be aware of, which I don't understand why, but it still is there, is that you cannot roll over an existing Roth IRA to a Roth 401k. It's a one-way street out, does not go back in. So you can roll over a Roth 401k to a Roth IRA, but you cannot roll over a Roth IRA to a Roth 401k. It's a very odd rule, but it is there. But basically, any type of pre-tax retirement plan, if it's still, or after tax, again, you can roll over an existing Roth 401k to a Roth 401k, but just the Roth IRA is that weird little carve out, right? But basically anything else, if it's carte blanche if it's pre-tax, right? So if it's traditional IRA, 457, 403b, 401a, 401k, TSP, all those kind of things can be rolled into a solo 401k. In addition, your contributions are not going to be limited by your rollovers either. So if you have 250, 150, 100,000, 20, whatever it is that you have in an existing employer-sponsored retirement plan, typically an old one, right? You know, you can be restricted from current employers for moving money out of those plans, but those can be rolled over directly into a solo 401k, and you can make your contributions on top of that, right? So contributions are not affected by rollovers, but great question. So the advantages of the solo 401k, you know, all the benefits, you have higher funding limits, you can defer a larger amount of your earned income, right? So, and additionally, especially if you're a sole prop or you're self-employed, again, if you have the ability to really kind of tailor how much money you're paying yourself in a given year, you can really tailor it to be the point, you know, in theory, you can do 100% compensation contributions. So for that $23,500 or the $23,000 for we're talking about last year, contribution, you know, you can pay yourself basically just that. Now, you do have to account for self-employment tax. Basically, it's less 1/2 of the self-employment tax liability on what you're paying yourself. So, you know, in reality, the amount of money you have to pay yourself that would be exposed to ordinary income taxes is going to be roughly, you know, somewhere, you know, north of that, not by a ton. You can't just pay yourself 23,000, contribute the whole thing. There's a small calculation that your accountant can help you with because that changes from year to year. But understand that unlike with a SEP IRA where you have to show a large amount of earned income to qualify that contribution, right, which is the hardest to shield from. So SEP IRAs, again, are really good for people that maybe make a lot of earned income, right? They don't have the ability to tailor how much money they're being paid out. So think real estate professionals, you know, property managers, real estate brokers. If you're getting paid a lot of money in that regard, SEP IRAs work really well for that, right? Because 25% is based on the total compensation that you're receiving. Whereas with the solo 401k, if maybe it's you have a single member LLC or your tax as a partnership, right? You can keep some funds within the business and then only pay out yourself a certain amount and then utilize the 401k's match contribution to further write off the business revenue that you're going to be, you know, bucketing in that area. So again, the 401k offers a lot of flexibility, but it, you know, doesn't always work for everyone, right? The SEP IRA definitely shows its colors. It definitely shines its colors when you look at people that have high earned income because of that. Now, additional advantages of solo 401k, you have access to tax-free loans. Unlike any other plan, you can do a participant loan and loan yourself money out of the plan. Now, especially if you need to use that for business expenses, right? You can borrow, you know, up to $50,000 or half of your vested cash balance can be done as a loan to you. It has to be repaid within 5 years, make at least a quarterly payment. The interest can be a point above or below prime. I know what some of y'all are thinking, saying, hey, if I borrow from the 401k, just peg it up 100% interest, right? Just double your money back into the plan. Can't do that. I like where people's heads at with that, but unfortunately, no. You know, you have very flexible contribution options, cost-effective administration for the solo 401k and Roth aspects as well. So again, that's pretty much what I have for you all today. I have a few more minutes for any questions. If anyone wants me to go back and cover anything again, I am happy to do so. We definitely have about 12 minutes left. So if you want to pick my brain about anything that we've covered today or how it might play out for you personally, feel free to do so. If that said, that is the end of the presentation. So handout is attached with a copy of all the slides. Here for any questions, but thanks very much for everyone for joining today.